And this has been what we call like leveraged DePIN mining, because the way that GLIF works is it allows the hardware providers to reuse existing security deposits that they've put down on the network to then go get more Filecoin to go put down more security deposits to keep that flywheel going. Ultimately, no amount of financial engineering will make up for lack of being able to sell the resource that your DePIN is trying to offer. Someone needs to buy that resource. Uber and Airbnb are not perpetually giving out rewards to their people to keep their network afloat.
Hello, everyone, and welcome back to the Unleashing DePIN Podcast. My name is Tyler. I'm your host, and I am very excited for our next guest. This is definitely going to be a conversation that I've been anticipating, looking forward to. We've got Jon, a.k.a. the DePIN Economist, a.k.a. the CEO and founder of GLIF. Jon, how you doing? Welcome to the pod.
Yo, thanks for having me on, man. I'm glad we're having a chat. Yeah.
I'm excited too. I first saw you on Twitter or X now, I guess they call it, because of some of your DePIN Economist posts, which is very much something that gets me excited. And so I was like, oh my gosh, we got to chat. So we've had a lot of fun conversations offline, learning about what you're building, kind of the intersection of the future of DeFi and DePIN. So I want to structure this conversation in a two-part segment. First of all, I want to talk about what you're building, because I think the intersection of DeFi and DePIN is wildly underrated and really exciting, and it's going to be super impactful for the space. And then I want to talk about some of the more the economic considerations that you've been writing about on X. So maybe the first thing we should start with, just to help orient everyone with this conversation, is who are you? What have you been building in kind of Web3? How did you find yourself here?
Yeah. Hey, everyone. I'm Jon. I've been working in crypto for far too long. That's why I'm always wearing a hat. I've been balding. You still have managed to keep a great set of hair.
I appreciate it, man.
Yeah. Maybe that's another offline chat that we can have about how you do that. Anyways, I'll take you back to 2017. I was an engineer at Consensus working on a project called Ujo. And Ujo was like this music crypto platform, and a lot of really good learnings there. But one of the key learnings for me was about IPFS, the interplanetary file system, which was very related at the time to Filecoin, which was like an incentivized version of IPFS. And for those that don't know, IPFS and Filecoin are both distributed decentralized storage technologies. They're considered or hoping to be more robust ways to store data. And it really caught an interest for me. I was like, this makes sense. The idea behind what are called CIDs, these like content hashes that allow you to look up data on the network from any node nearby by its content, was really intriguing to me. We could have a whole conversation just on that, but I'll spare the details for now. But fast forwarding a little bit, I ended up leaving Consensus with a friend and started a dev shop for just building like custom IPFS solutions for different crypto protocols. A lot of DAOs and identity projects at that time. But that ended up leading to Protocol Labs reaching out and saying, hey, do you want to help launch Filecoin by building the first Filecoin wallet and the multi-sig? And so we built a lot of critical apps and tools for Filecoin's mainnet launch, which was branded GLIF. So GLIF was this like umbrella brand for the critical apps and tools we were building for Filecoin's mainnet launch. Fast forward another couple years, and GLIF put out Filecoin's first DeFi protocol, which it solves the same problem that, say, Lido solves for Ethereum, but it does so in a uniquely Filecoin, uniquely DePIN way that allows the Filecoin storage providers to lever up on the existing capital that they've put down into Filecoin to get more Filecoin for more mining and activating more hardware. And that's gone exceptionally well over the last 2 years. And just yesterday, big news was when we launched our token and also announced our multi-chain expansion. And now we're here. And this is why I've been more vocal in the DePIN space. I've been told I can't code as much. I need to do more talking. And just to be clear, I think there are many DePIN economists, you especially as one of them. I just happened to grab the name on X. So yeah, I think I'm happy to be here and to just jam on ideas with you, man.
I love it. We've had a lot of interesting conversations, definitely through the thought leadership that you're publishing, and then also just figuring out or understanding the intersections of DeFi and DePIN, because I think that outside of the the economic style research that you've been publishing, I think that there's such a opportunity for DeFi to really either push DePIN forward or maybe vice versa, where DePIN really pushes DeFi forward because it's crypto native by default. They're so receptive to both of those models. I want to understand a little bit about how you're envisioning the future of GLIF, because obviously what you built for Filecoin is really applicable outside of just the Filecoin ecosystems. And so as you've gone multi-chain, can you kind of share what the future of GLIF is going to be for those intersections as you're building them?
Absolutely. And I think for us right now, we feel more directionally really confident in the individual execution steps to reach that direction. We're still designing and researching. So a lot of new information will be coming out as in the next even couple weeks as we finalize some of those plans. But generally, I think it's quite obvious and objective that in the age of AI and Internet of Things devices, robotics, hardware is becoming more valuable. And essentially, I think that there's a future world where many different types of hardware have earning capacity for you, right? So when we're not quite there at the mainstream yet, when you have some thing that you're not using, that should trigger an alarm in someone's head is I'm actually losing money by not putting this thing to work. And there's some really interesting examples of this. There's like an Uber for winter coats. Have you seen this? Like even a winter coat in a way could be like a DePIN asset kind of peer-to-peer market where it's like, hey, I'm inside today, I'm warm, but there may be a tourist nearby that's actually really cold. And I might just be able to go rent my winter coat to them for an hour. And so like the idea here is like with GLIF, I think we want to be at the intersection where folks who have hardware or physical resources that could earn for them passively, we want to serve as the intersection between that and like DeFi services that allow them to get better capital efficiency off of those assets. You know, what exactly that means, that's exactly precisely what we're about to find out. And it's so hard to tell, right? Even with things like quantum, other types of future hardware, it's very unclear how this will play out. And so we're basically now in the process of running a number of different pilots and experiments to figure out, hey, what are the newer models that can work with even bigger types of hardware, more diverse user groups, even with outside of crypto as well.
Yeah. Yeah. No, I love that. Maybe one of the level setting places we can start just for folks to understand how you got here is, what does the state of Filecoin look like today? And specifically, can you help people understand this challenge of being able to rehypothecate capital or having additional efficiencies, which led you to develop where you're going with this multi-chain, multi-DePIN project approach or architecture?
Absolutely. Absolutely. So I think we're getting to the point in DePIN too, where we're going to have to like decouple certain individual projects from being related to each other under this one hood, right? Uniswap and Lido are two completely different protocols, right? Like it's almost hard to compare them, but they're both DeFi. And now I think DePIN is like maturing into a way where we get there. And the way that GLIF operates and the way that Filecoin works as a DePIN is one version of DePIN and DeFi and DePIN. So I think let's talk specifically about Filecoin. So a bit of context and history I think is important here, in that the way that I see how Filecoin's maturity has worked over the last 4 or 5 years has been about, it's like a three-part story. The first part is about building a blockchain. Like Filecoin is a layer one, right? And at the time of 2019, 2020, there weren't like other blockchains that you could theoretically build Filecoin on. It wasn't like, maybe Ethereum at the time, but it made more sense to roll out a special purpose blockchain for storage. And at that time, the most important things to work on were like blockchain-y things and also just like bringing on hardware capacity. Yeah. So that was like the first part of the story. And that worked exceptionally well. Huge amounts of capacity, exabytes of storage ended up contributing to Filecoin. The second part of that story is turning capacity into useful storage. And there's a concept on Filecoin called Fill Plus or data cap, which is it's a bit of a controversial part of Filecoin, I would say. But this is basically a mechanism for converting capacity into useful storage. Now we're at the third inflection point, which is turning useful storage into paid storage. And this is arguably maybe one of the harder jumps because a lot of people will take free storage. Even if it's useful, it could still be free. All right. So a lot of what Filecoin will store today are like public data sets and things that like we should be preserving and archiving, but there isn't necessarily a client that's paying for that on the other side. It's the Filecoin network of block rewards and the incentive structures behind how the network operates. And now we're getting to the point where, hey, essentially for storage providers to really thrive and for the network to have 50-year sustainability, the network needs to start charging money for storage. And that becomes a pretty tough jump. And so I think when it comes to building on Filecoin right now, it's helpful to skate to where the puck is going, right? So understanding that let's look at Filecoin 10 years from now and say, if Filecoin succeeded, what had to have happened in order for that to work? Paid storage was one of those big things. And so when you're building protocols on Filecoin, I think it's helpful to be building with that future in mind. Filecoin as a paid storage blockchain, you wouldn't build certain things that you would build on, say, Solana or Base or Ethereum. You will be building other types of protocols that will help achieve greater benefits when it comes to paid storage and different types of storage protocols. So I don't know if that directly answered your question, but
yeah. Maybe one of the things that'd be helpful for people is to understand some of the challenges that currently exist around like staking and what that means for like hot storage. You've got cold storage. There's sort of in a lot of respects redundant where you don't necessarily need that. And then there's also like this interesting challenge around when you stake, you can't necessarily use that stake to create additional sort of value accrual, if you will. And so I know that's really core to what you're solving. Can you maybe help folks understand like what specifically some of those challenges are and how you're actually making the market more efficient through GLIF?
Oh yeah, absolutely. So when it comes to Filecoin, and this model, I think you can extrapolate from Filecoin to like networks that look like Filecoin. So there's other GPU networks and CPU networks that kind of operate in similar ways. Generally, the provider of the resource, so in this case, it's storage for Filecoin, they are forced to put down a security deposit in Filecoin to ensure they're acting honest and they're doing the right thing. So on Filecoin, that means every day I'm actually proving that I have the data that I say that I have. And if I stop proving that I have this data every day, then I start to get slashed. That security deposit starts to get taken. And so this becomes a challenge for big hardware providers to activate all of their storage space on Filecoin, because that security deposit for, say, petabyte scale storage, which is huge, by the way. If you look at some of these Filecoin storage providers, these are like massive data centers, right? These aren't like little hobbyist miners. Generally, to activate all of that hardware, it could become prohibitively expensive in Filecoin. And so what GLIF does is it allows token holders to put up part of that security deposit for the storage providers so that they can activate more hardware and mine more. And in the process, those liquidity providers who have Filecoin tokens, but they don't have the hardware to mine Filecoin or the knowledge or the desire for what it's worth, like it's a hard business, those liquidity providers can earn rewards. And so we've basically made a market where there was a huge gap. There was no way for liquidity providers to put their Filecoin tokens to work in a productive fashion for the network to increase the size of the mining and stuff like that. And there was no real easy and permissionless way for the hardware providers to get access to that capital to level up their mining game. And this has been what we call like leveraged DePIN mining, because the way that GLIF works is it allows the hardware providers to reuse existing security deposits that they've put down on the network to then go get more Filecoin to go put down more security deposits to keep that flywheel going. And yeah, I think that's generally, does that make sense, or should I answer? 100%. Yeah, okay, perfect.
Yeah, that makes total sense. And one of the things that I think is really interesting is they call it this levered DePIN mining. You've obviously proven the market within Filecoin. What other networks you talked about compute and GPU and whatnot, but like what other types of networks or DePIN projects do you foresee being like really receptive to this type of levered DePIN mining, if you will?
Yeah, I think really any staking network that requires a security deposit is a network that we could theoretically support. So generally it's in this like restaking world, right? Where if you look at certain other restaking protocols, it's like you essentially have a system where you have a group of people that's putting up capital to secure something that is separate from the folks that are actually securing it, right? So, and I don't fully understand how all of the risk works in these systems, but like with GLIF, you have folks that are actually mining these DePIN networks, And they have skin in the game already. And so any network that requires the supply side to have skin in the game can essentially work with GLIF to collateralize that skin in the game to then allow miners to benefit more and to create better capital efficiency for that network. And so GPU networks are ones that are close to Filecoin. And I think when you think logically about GLIF and our customers, so our hardware providers are generally folks that run data centers. So they have storage space. They also have GPUs. They also have CPUs. And so they're probably mining other networks as well. So for us, the natural next networks to support are the ones that our customers are already involved with, if that makes sense.
Yeah, that makes total sense. What are the other types of, call them DeFi applications within these DePIN ecosystems that you either see as interesting or you think GLIF might be able to directly support in the future over this rehypothecation of staked tokens to be able to participate at that, call it multi-layer stack?
Yeah. Okay. Ones that GLIF are really interested in, what like pretty much all of our experiments are around inventing new types of collateral. That's where we shine. And like earlier in this talk, how I was talking about, imagine if I could actually somehow collateralize my winter coat because it has earning potential, right? In this like winter coat rental market. That's the type of stuff that we would, again, winter coats are maybe a little too degen, but like theoretically, this type of relationship is the one that we're trying to activate for many different types of tangible goods that can earn revenue. All right. So now, other things that I think are really interesting, and this gets into some of the stuff on the DePIN discount rate that you wrote. I think there's a lot to be experimented with in the stablecoin realm, and like specifically, I think, and your article talks about this a decent amount, right? So we talk about buy and burn as a potential like business model for DePINs, right? And the idea there is you emit tokens to the supply side of the network, and the tokens that are used to purchase the resource in this network are basically burned. Whether you pay for them in dollars, then you go buy this token and burn it, or you just paid for them in the token and it gets burned. Now, like the interesting thing here is around UX, right? So I generally think that most customers who are used to buying resources that could be offered by DePIN networks are used to paying in dollars and not holding on to highly volatile crypto assets. So when it comes to paying in dollars, how can you basically have a strategy that helps accrue value to your network's token is an interesting one. Buy and burn is one option, but my issue with buy and burn, and I think we're going to get to this later in the chat, so maybe I should shut up for now, but I'll leave it short. My issue with buy and burn is that I think it's a potentially not the highest ROI investment that you can make with revenue. So I think stablecoins are an area that are worth experimenting in to do better with revenue. And so what I mean by that is, like on Filecoin, actually it's probably coming out in a few days, I would say, even, is a stable coin that is like liquidity. So it's collateralized by a single asset. And that asset is Filecoin. And so you can imagine, as the amount of dollar-based, fiat-based storage deals, paid storage deals happen on Filecoin, it requires more stablecoin. Right. So as the stablecoin volume is going up, the collateral that is needed to back that stablecoin is also going up, and that is Filecoin. So now if you are essentially using revenue, instead of burning tokens, you're actually just using it to get tokens to mint stablecoins to create more like potential volume to trade in. Now you're basically locking up your token to collateralize a dollar that then is used to pay for deals. Now, this to me is a really interesting area to experiment in. And then it comes down to, how do you make that stablecoin a little less risky? Because you have it collateralized by a highly volatile asset. And then you can start to introduce different types of collateral types. And so there's that project USD.ai, which I find really interesting, that's running an experiment in this domain. And I would love to see more experiments on that side of things, especially around customers. Yeah.
Yeah. I 100% agree with everything that you just said around the burn and mint equilibrium, also this introduction of stablecoin. I think there's a couple projects, one of which that we've been doing some work with, that I think is promoting a very interesting idea in that realm. And I think it solves a lot of the challenges that we've seen around out of control emissions, or the fact that like your customer base isn't going to pay for things in crypto 99% of the time. They're going to be paying for either like an API key in fiat or just using the network. And I definitely want to get into that. But maybe the nice segue into that economic conversation is you guys are employing or using a unique tokenomics design within GLIF that's maybe a little bit more akin to the model you just shared. Can you talk through how you've been thinking through the use of a token within GLIF? I know you just had your airdrop, and maybe we can use that to start having more of these more general conversations around DePIN economics.
Yeah, absolutely. So the model for the GLIF token is not out yet. The token is out, but we're still working on the model. And generally, we think about the economy in a mint and burny kind of way, right? If you're constantly minting and not burning, you have inflation that everyone's getting diluted. Eventually, that type of thing loses value over time. You also have on the flip side, if you're only burning, now you have this like deflationary situation, and the asset ideally over time would end up going up. Now, it's helpful to separate DePIN tokens from DeFi tokens, because I think with DePIN, and especially when we're talking about like revenue, I'm not sure yet. I still go back and forth on this. Like if these tokens represent commodities, why should they always be increasing in value? I don't really understand that necessarily. Whereas for a DeFi project, like you don't have the same constraint because you're not pricing a resource per se, unless the goal of that resource is to become more valuable, like a hyperliquid auction or something like that. This is a little bit different in that there's bonding curve mechanics kind of things involved, and the earlier you are, the better. But for buying something like Wi-Fi, or it doesn't really make, like earlier shouldn't be like cheaper for internet necessarily in my mind. So anyways, when it comes to GLIF, we think about minting and burning. But the one interesting, I think, nuance here for us is that we don't actually we would like to be able to earn revenue and not use that to buy and burn tokens. We would like to reinvest that into making better products. So buying and burning, if we're being honest with ourselves, I think if you look at traditional equity markets, right? If you have extra cash, the first thing that you'd probably do is reinvest in the business, right? Like a startup SaaS tech company, very unlikely they would ever use cash to pay a dividend to their investors, right? When we talk about buy and burn, we're talking about clever mechanisms to do stuff with extra cash that should have positive price appreciation on your token in a rational economy. Now, why are we doing that now is the question that I have for early startups, right? You should almost always be reinvesting the money that you earn, especially before you're really profitable into the business, right? To make it better. Now, before you pay your investors dividends, investors are the last on the capital structure sheet, right? So generally with GLIF, I think we're thinking about this in a bit of a different way. We want to sell products that folks buy with GLIF tokens. And when they buy those with GLIF tokens, those tokens get burned. That is separate from how the company can earn revenue on its staking products and stuff like that. Now, the difference here is that the onus is on the token holder to burn the token itself to get the benefits that they will get from this product, right? So the onus then becomes on us to build good enough products that the holders of these tokens would rather burn them than sell them. And one of the things here that personally I like to think about is, okay, imagine if your airline miles had a secondary market. Now, for me, I have a bunch of airline miles from all my traveling. And if I could get cash right now for all of them, would I do it? Answer is depends, right? Because I know that I can get benefits from my miles from the airline, right? So I need to make a comparison now. I need to understand, should I burn my miles for flights, or should I go sell them on a secondary market? And there's some arbitrage in there where it's at a certain level, I would much rather just wait and use these tokens or use these miles with the airline. And so for GLIF, that's how we're measuring our success. Okay. We want to be building products that folks use, using miles to buy a flight, right? If people decide, hey, we'd rather sell our GLIF tokens than buy products from GLIF, then our products are not good enough. And that's the bottom line, right? When I get Chipotle points, I'm using them at Chipotle, right? And so that's how we're thinking about the token. And the multi-chain world for us gives us a lot more of a canvas to experiment with different products. And so, yeah, I think that's generally the framework that we think about tokens in.
Yeah, that's super interesting. And I appreciate the fact that you've been thinking through this at such a thoughtful level, because it is really complicated in a lot of respects, but it's gotten to the point where it's almost like we've just put blinders on and accepted the status quo and not really thought through all of the downstream ramifications as we are starting to see protocols get success, whether it's through demand validation, revenue, all these things. And like, I've had my qualms with some of these models, whether it's like the burn and mint equilibrium or just other mechanisms that have been deployed. So it's really, maybe it's validating on my side to hear other people say, maybe let's take a second look at some of this. So I'd love to just pick your brain a bit about how you're thinking through these concepts or models as they are applied to different DePIN networks. I know one of the challenges that's difficult in a lot of respects is that not all networks are the same. They've got maybe different timelines between having enough supply to be able to actually support demand, or there's just other, maybe less of an incentive to want to spend in network. But how are you applying this, call it airline mental model, to how DePIN economics should be built out in the world? And maybe if you have a couple examples that we can talk about to make it tangible, we could start there.
Absolutely. So this is a really good question. I think I need to think about it a little bit too. Like, the loyalty-like programs for me are really interesting. I don't know that they're like broadly applicable in every DePIN. Again, like GLIF is DeFi for DePIN, but in that way, like it's more DeFi than it is DePIN. And I'm like, applying loyalty rewards to DePIN. Interesting thought. Like, we should like pencil that in. I haven't really spent enough thought cycles on that. So let's come back to that. I think, how do we think about tokenomics for DePIN in general is like a fair question. And like, for me, I don't think actually anyone has necessarily gotten it right. And that's not a shot at anyone. Like, we're all in the arena trying things, right? And some will work and some won't. And so a huge amount of respect to all the experiments going on. I think generally, like, for me, I try and find something that is already existing that looks really close to like another thing to extrapolate some information and as like an anchor point. And so personally, I like Uber and Airbnb as anchor points for DePINs that are shared economic models. So Uber and Airbnb are not good anchor points for a network that acquires a resource together and sells that resource together. So I had a friend working on a product that you basically spin up a dark web scraper, and it just, everyone is scraping credit card information off the dark web, and then they package it all together and sell it back to banks. So that's not a peer-to-peer shared economy model like Uber or Airbnb. Filecoin, or like these types of GPU networks where you have a client that needs to rent some hardware for a period of time from someone, is more like Uber and Airbnb. So for this example, I'm talking more about those networks. And of course, I'm by far the most familiar with Filecoin and those types of networks. So I use Uber and Airbnb as an anchor there. And generally, Uber and Airbnb have built a product that is so good that both the clients and the suppliers pay. Uber and Airbnb are not perpetually giving out rewards to their people to keep their network afloat. They have found something that is valuable enough where they do not need to pay either side of the market to keep going. And DePIN, we do that. Again, like, it's very different for these, let's aggregate a big resource through a bunch of small peers. That's a different model. But in the shared economy models, like this peer-to-peer renting thing, I actually don't think that block rewards are even a part of that forever. Like, generally, which is maybe a hot take, but like, I think that if we take the role of network inflation in DePIN and we talk about what is the role of that, for me, in a lot of ways, it's a subsidy. It allows the hardware providers of that network to compete with the major cloud or like centralized players, because being like an indie data center, an indie hardware provider, you incur costs that you can't amortize over a huge amount of quantity. And so you need a subsidy sometimes to be able to compete and offer prices to the end customer that are cheap enough that they would choose your indie DePIN network over AWS. Generally, like, block rewards and tokens are good for subsidizing. Now, does that have to come as perpetual network inflation through emissions and like through block rewards? Or could you do that through some other mechanism? So if you think about what are the block rewards for Uber, it's actually like that give 20, get 20 thing, right?
Yeah.
And that's only available in an area, right? Remember how Uber, when they started, like they don't just allow some random car in Minnesota to sign up. Like they're focused on San Francisco, and they will subsidize San Francisco until San Francisco is active and has enough of, again, what you're talking about, like supply critical mass. I really like that concept. And like actually in these shared economy models, I think there's a demand critical mass as well. Uber, like if Uber had figured out, hey, we have all these drivers, but we can't get any riders, they might have started subsidizing more rides because that's where there's not enough demand. So in fact, and this was an early thing that we had in Filecoin, was negative pricing for storage, because it was like, where it was like, you can, with block rewards, you can turn Uber into a situation where drivers are actually paying the riders for rides, because by giving rides, they're earning block rewards. And like that model doesn't click for me in a sustainable way. It doesn't make sense. So I think like, how should we be thinking about tokens? Like at a very high level, there's funny, silly, magic internet money, financial engineering tricks that like for years can make sense, but like hard to reason about. For me, I'm like, if it smells funny or it doesn't like click and it's really complicated, there's something here that's like not working in some way. Maybe I'm too like not clever enough, but I think simple is good. And when you make a product that has supply and demand matched, block rewards you will have a lot more power to use a token to do much more interesting incentives.
Yeah, I 100% agree with everything that you're saying. And so maybe we can break it down a little bit for folks. So let's maybe start on the supply side. I know you recently had an article that was talking about KPI-based supply, or basically emissions, which relates to supply. How are you looking at the early incentive mechanisms for whether it's through emissions/subsidy, which are effectively one and the same? And then at what point do you think either that model no longer fits and we should look at some other, like one of the other hot takes was basically like supply participants should potentially have to pay in to get exposure to demand side revenues? Like, how do you A, see those two interfacing, or B, at what point does it make sense to have a supply model or a supply side participant actually pay in to get demand revenue? Like, how are you thinking through those things within DePIN networks?
Yeah, absolutely. So let's switch off the shared economy model stuff, because I talked so much about that in the previous question. But generally, I think KPI-based inflation can make more sense with projects that are working together to aggregate a resource. So the more resource that we've aggregated together, the more we all get paid, kind of thing. And as things, like the reason that this works is because it's give 20, get 20 for Uber. Like me bringing you on does not affect my ability to get rewards. Actually, me bringing you on gives me $20 too, right? So KPI-based emissions are like a fancy referral program for block reward distribution. Yeah. So that becomes really interesting when, again, doesn't really make sense in a shared economy model where I have some storage and I want to find someone to rent it, because, hey, if I bring a competing storage provider on, now we're competing for the same customer potentially. So it doesn't really make as much sense in that regard, unless you're trying to just bootstrap to get to that that low level of supply to call yourself a legitimate network. And I think that's what a lot of these projects do. Like, it becomes easy to use a token to get capacity on your network, and then it's addicting, right? You just keep going. But let's talk about more of the data aggregation networks, because I think this is where it looks really interesting, because actually, like, in perpetuity, you do actually want more people. So let's use like GPS, like peer-to-peer GPS mapping. This is an example where the more the merrier, right? Like maybe there is a plateau of useful GPS data, but it seems like you would need a serious amount of critical mass before you hit that drop-off point. The second part about GPS that to me makes it lends itself better to this KPI-based model is that the KPI is actually easy to design, because I think that location data is somewhat more fungible than other types of resources. So like you could say, as we've gotten more location data, that's the KPI. But I find it sometimes very hard to set KPIs for DePIN networks, because the resource that we're accumulating together is actually non-fungible. And it depends where you are in the world and who's actually accumulated it. So like we can use energy networks where like energy is non-fungible. Like energy in California is a lot more expensive than it is in Texas. Now, I'm not an energy expert, but like to me, having a network-wide KPI around energy doesn't really solve this problem that well, because like I might want more energy in certain geographic regions where it becomes more valuable. And so then you need to have location-based KPI rewards. And now you're introducing something that becomes really difficult to do in an automated kind of human-free nature. So then it's, are there better ways to give out these games or these like rewards? Like, why aren't we trying give 20, get 20 for solar panels instead of using block rewards, but doing the give 20, get 20 through your token? And then ideally we're selling energy, and that's how the people make money, right? Like that to me is, yeah, again, it's really hard, right? This is playing the game on a really hard mode, because the argument for doing some of these like inflation games is it fits the current meta really well, and it may become really easy to increase the speculative value of your token, which then means you go make some deals with some market makers and give them some good call options, and now you've just fundraised for the next 10 years.
Yeah.
So what actually is the better strategy for your network? It's unclear in the current capital structure in the market.
Yeah. I love your example of fungible, non-fungible resources. In the DePIN discount rate article that I published, the way that I had categorized that was basically TAM sensitivity to supply side decentralization. So effectively, if like you have a bunch of network nodes that are in New York, but your actual resource consumption is happening in a place like Texas, for example, then you've got like a very high relationship to the necessity for the network to be decentralized on the supply side. But I love kind of thinking about it in like this fungible, non-fungible term. In terms of the translation from the supply to kind of demand, you talked about the challenges around the burn and mint equilibrium, because there's obviously demand considerations, there's emissions and how that sort of plays in. Can you unpack for me a little bit more this airline point stablecoin concept? Because I think that this is going to be a model that lends itself really well to a lot of different projects, but I'm not sure it's a little bit inverse or counterintuitive to what we've seen thus far. And so I'm curious if you can maybe shed some additional light or just thoughts as how you're thinking about that from a DePIN economy standpoint.
Yeah, absolutely. So I think the question that we're like trying to answer, like in the macro, is like, what is there's two questions. The question that you've been trying to answer, which is really honestly maybe more important at the beginning, also like maybe a predicate for the second question, is what is a standard valuation model for DePIN networks and crypto networks as a whole, right? And that's a very hard question to answer. It's also a very hard question to measure in a way that's not gameable.
Yeah.
And so there's like the theory behind valuation, which I think directionally you're like really right. I agree with most of the things in that analysis. So directionally, I think it's spot on. Implementation wise, like how do we actually go about doing this? Is another hard question. I think like DePIN Ninja, I'd seen asking similar questions like, how should we actually count this transaction? Is this revenue? How do we know if this is self-dealt revenue? So anyways, we need to figure this out. But ultimately, the second question is, what is the best thing that a DePIN network can do with its revenue to increase the value of its token? And that's that to me is an unanswered question. And again, if there was standard valuation practices, you would know, right? This is how we increase the value because this is the formula.
Yes.
And so that becomes, in a lot of ways, I think that's how markets mature. And so we can disagree on assumptions, right? Like we could disagree on what the multiplier for, or what the supply critical mass is for this particular network. Or we could disagree on those assumptions of those variables. And that's where the alpha is, right? But we're not disagreeing on the model. So generally, I think we're all arguing about how do we spend our revenue without having a compass, right? And a lot of the times the compass that we use is reactionary to how did the token perform when we made this decision, which is actually a really bad way to measure it because these markets are really largely irrational.
Yes.
And I think what I've been like, I guess the answer is I don't know either. And I am looking to figure that out. I think the idea behind loyalty programs, backing stable coins, doing market making, like you could use your revenue to market make instead of buying and burning, and actually just buy back and don't burn and redistribute so that you have a fixed supply, but you have a burn mint equilibrium. So there's a bunch of models that we haven't really tried because we haven't had real working products. So we've started out with financial engineering, and then we've tried to back into, hey, now we can actually make a product. Yeah. So I think like ultimately, no amount of financial engineering will make up for lack of being able to sell the resource that your DePIN is trying to offer, whether that's peer-to-peer shared economy style, whether that's let's work together and aggregate a resource. When someone needs to buy that resource, that is absolutely most important thing. I don't think all the projects in the market are adequately compensated in terms of valuation for having figured that out. And that's a sign, right? That smells like immature markets. And so that for folks like you who can see that, like that is the alpha, right? And I think like it's also a weird thing in that there's a built-in disincentive to do this, because we may find out that once we have it, we really don't like what the valuations say about these networks. And that's a hard pill to swallow as well. But sometimes like a little course correction is necessary to really get to the higher ground, I would say. So this is not a very helpful answer to your specific question about stable coins or loyalty programs, but reframing them as these are experiments that everyone is trying to run to figure out what is the best way to spend revenue. We can go, I'm happy to dive deeper into like, how would you actually construct that?
Yeah.
If you want to. Yeah.
Yeah, I would definitely be really interested in getting your takes on that. Maybe one preliminary question to help frame that, because we've often thought of these DePIN networks, or we've really implemented them in this one token model. So assuming that we continue with this one token model and we don't start introducing additional concepts like a stablecoin or these loyalty points, what is your general view on categorizing tokens? I heard you say earlier they're a commodity, but I think one of the challenges is like tokens. In Chris Berensky's initial MVPQ model, he's like, tokens are a store of value, a unit of account, and a medium of exchange. And like I saw Saul had a comment about thinking of these things like convertible debt. I actually really like that kind of mental model for thinking through these tokens. But outside of getting more nuanced around stable coins or loyalty points, like what's your general take on how we should categorize these DePIN tokens? And then we can further extrapolate what that looks like in terms of actually whether it's burn and redistribute or burn and stake, burn and mint, so on and so forth. But on the demand side, capture a little bit later.
Yeah. The intuitive thought that I have on it is that one token should represent one unit of resource, or there should be some conversion there, right? Like if your token does not represent a way to capture the resource that the DePIN network is offering, then why do you have a token in the first place? Is my question. Then the resource is priced in dollars, and like you don't. Yeah. So I think like for me, the token should be at the lowest level, the thing that purchases the resource from the network. Now, that does not mean that's the thing that you have to introduce to the end user, right? Mm-hmm. So when we talk about the stablecoin thing, we're essentially talking about a pipeline that behind the scenes, the user doesn't need to know about, where the native network token is being used, right? It's like a unit of account within the system of the DePIN network. And to me is like a decent way to go about it. And I think that's like ultimately what they should be for. And I don't know exactly how the best way to do that. Should they be fixed? Should there be a fixed conversion? Should it be some sort of like surge pricing when the network has very limited excess resources to offer? So there's different things to try there, I think. Yeah.
Does that lend to the idea then that we should bifurcate like a unit of account versus the medium of exchange, then to your point of having maybe a secondary measurement for actually either capturing the access to a network or what gets represented as the dollar denominated value for demand within a network?
Yes, absolutely. I'm a big fan of theoretically, I'm a big fan of having different tokens represent different resources and different mechanisms. Like I am, when I write code down to like individual functions, I do the same thing. One function does one thing. Then if I want to have a function that does multiple things, I have that one function that calls multiple individual functions, right? And so I think when you have, and I think Sal put that post out about, was it Verizon or some mobile network that showed how many different securities were actually involved in one company. This is the same thing. The issue is the bulk of retail is not sophisticated enough to understand this And there's also not enough regulation where there wouldn't be a conflicts of interest. So like the teams are not organized well enough. The legality side is too hard, and the incentives are all messed around to the point where I think it would be really complicated to pull off. And it might not be successful because it's complicated to the end user, but it may actually be the right design. And so then you have to decide, like, how much do you bet on the space getting smarter versus and doing the thing that makes logically from first principles the most sense potentially, versus playing the silly crypto game and capturing everything in one asset and saying this token does everything. Yeah,
I think it lends to competing incentives, and also you're effectively trying to capture whether it's future value or the ability to spend. They're just competing values there that make things challenging. So one thing that I'm curious around, maybe independent of whether we have this sort of stablecoin, loyalty point, two token system, we talked about this a little bit with the MVPQ model, where you've got quantity provisioned on the network, and also this sort of concept of velocity, which is tokens that are maybe like an externality from actual quantity resources being provisioned. So transactions that are directly to access the network, and then sort of all the other transactions over that, where velocity has a negative impact on price overall. What are your, that's created a lot of contention around the space as we've looked through these kind of valuation metrics. So I'm curious, like in a network where we know we need to have people that see a future value independently of how we actually do that, whether it's again through stablecoin or points, are there specific metrics or things that we should be looking at, like total value locked, staked resources, to serve as an offset for either out of control velocity or quantity being provisioned, where you want a high throughput because, again, the medium of exchange going up means more value accrual to the actual network design? So do you think it's like a TVL metric, percent staked, just bifurcate the two altogether so that you don't even commingle those variables? Do you have any thoughts on that front? Because this is something I've really been internally digesting and trying to think through myself. I'm curious how you're thinking about this.
That's a really good question. Yeah,
it's a really loaded question.
Yeah, no, you said a lot there, and I'm thinking through the velocity stuff too, because I hadn't been that's new to me as well. But so I think this might not be super helpful, because I feel like there's a pipe dream for me that I see that I'm like, this is how, like, in a perfect world, the way things would work. And then there's like the reality, which is not really that. And so like the pipe dream becomes useful as like a North Star, but in this instance, I don't know that it really can be like made helpful in the current state of things. But let's just talk about the pipe dream first. So generally, I think there's two types of products that we can produce as a DePIN industry. There's ones that replace existing products, right? AWS could be replaced by a DePIN network. Then there's other types of things that are brand new. So we could not have actually done them without DePIN doing this. Yeah. So let's talk first about the replacement types. So for me, generally, like at the end of the day, I think we want to look at the end product of a DePIN network's offering versus its competitor in Web 2, and literally just be like we do not have to invent any new metrics, I don't think, at all. Like, we should be able to compare with existing frameworks for how successful is this network? What makes AWS traction? How do we describe it? It's not TVL, right?
Yeah.
We would never describe AWS as being successful by the amount of staked assets in it, because that's not what the customers care about. They want uptime, durability, pricing, repeat customers, cost of acquisition. Like, those are all the things that any traditional startup or investor would be looking at. There's so many more things in crypto that so many teams use as a vanity metric that it gets blurry. But ultimately, like, the only thing that matters is the customer, in my mind. Like, again, financial engineering is helpful. Like, we could compare this to like stock splits, right? In equities. Sure, there might be like a psychological benefit for us cutting the price of this stock in half. But ultimately, the thing that gives the stock value is this product being in high demand. So that to me is like pipe dream, and why I'm saying like not super helpful for the status quo, right? Because we don't have that yet, really, in a good way. So then it's like given what projects have now, what are some metrics that we could use to look at early indicators of healthiness? And I actually think like it might be easier to look the other way It might be easier to look at networks and say, these are red flags. And if networks have these things, they're actually like, they become less valuable or more risky. Some of those things would be like the amount of inflation that is going into suppliers, right? Okay. What percentage of that is happening? Then for the token holders, how fast are they being diluted? And what mechanisms did they have to index themselves to new inflation? Because if we look at how the network will go, if we're just continuously inflating to suppliers, like these suppliers who have higher fiat costs than say running an ETH validator, like they are forced sellers, right? So now you have like essentially a bottomless pit of we're minting our tokens into this pit and we know there's some amount of forced selling just to pay the fiat bills.
Yeah.
So if you follow emissions down to the recipients and then figure out if they're selling and you compare that with the amount of revenue that the network says that they have, you can learn a lot. Because if this network says they have $100,000 of stablecoin revenue on chain this month, but we're not seeing any, and like the stablecoin charts of revenue are going up, it looks really bullish, but we're also looking at all the node providers who are providing the same amount of service are still selling or increasing their selling. That story doesn't make sense to me.
Yeah.
If they're earning revenue, they're getting it. Yeah. So I don't know. I'm just rambling here, but yeah, I don't know, I think is the short answer again.
I'd be curious to get your thing because like, as I've been working out this model, one of the call them KPIs that I've been investigating is like in stocks, you got like mean reversion and like how quickly things revert to the mean in volatility. One of the things that I've been thinking through is like how quickly do people revert to holding the base asset as potentially an indicator for future value, and whether that's future value that will accrue or just people that have an incentive to hold the underlying asset versus just selling it. Maybe one way to at least project what is going to happen in the future. And so this could be like whether people have to sell because the emissions are offsetting any of the revenue to offset the cost to run the network. Do you think that might be a reasonable metric to look at for, call it, longer term viability as it relates to emissions and DePIN value capture or the demand value capture?
That's a good question. I think yes and no. My concern with it is it's somewhat cyclical in nature, right? So like the fact that I decide to hold might trigger you to say this network looks more valuable, which then allows me to benefit from the value. And then that keeps going, right? So like a valuation given to a network shouldn't cause the network to increase its actual value, if that makes any sense.
Yeah.
You know what I'm saying?
Yeah.
There's a big speculative nature here, which is why if we go back to loyalty program thinking, I think one challenge here is teams can choose to put their most important metrics very easy to measure and really but it's scary because it will likely fail in a lot of instances, right? So I tell you like, hey, GLIF is building a bunch of products and our goal is to sell those products priced in GLIF tokens, right? Now we are putting ourselves out there, right? If we don't sell a single product, people will be like, that sucked. And that is scary, right? You need to have courage. If we didn't do that, it will be easier for us to lie to ourselves about what this might actually be worth one day in the future. But we don't really care to play those types of games.
Yeah.
So the idea here is let's imagine a DePIN network that you can mine it as much as you want and you can take the supply, but the way that you get the revenue from the network through like real sales is by essentially you burn the tokens that you earn through mining. So now for me, this is a much better way to determine the value of that token because it's not just me holding. I have to forego those tokens in order to get revenue. And now that's a real signal for the network, right? I think tokens to me are technical mechanisms for delivering something to someone, right? Like if I were tasked with building Chipotle rewards, I would actually look at ERC20 as like an interesting, correct technology to use to implement that. Now, like if I value how much are my Chipotle rewards worth has nothing to do with, it really has to do with how good is a Chipotle burrito, right? And like, how do we know that if I'm willing to spend my points on Chipotle burritos, then like the burritos are worth a lot. And then we can extract value about how much those points were worth. But like when we try and value tokens for the sake of tokens without considering what they get you, it becomes hard. It becomes, now we're just valuing a thing based on that thing in isolation, when really like the value of this token depends on the resource that it represents to me. Yeah.
And the way that I've been thinking through that is a variable in a larger kind of equation where the a top-down valuation metric would start, or model would start with, what is the actual revenue capture? But it's challenging because you've got what I would call competing token incentives, or competing incentives for there to be a match between what could be a variable that indicates this is going in the right direction versus what is the actual kind of value being accrued, and then the token stuff is happening completely orthogonally or independent from that, and so therefore there's like this dramatic mismatch. And it is really interesting to hear your thoughts on that. What I'm kind of getting from this conversation is, I think the way that we start looking at these things needs to be ground up redesigned around whether it's this stablecoin point model that has obviously the revenue capture that creates the right incentive. At the end of the day, to your point, it's around incentives. Do I want to spend this token to get burritos, or these points to get burritos, or do I want to maybe hold on to them or sell them on the secondary if there's an arbitrage that might be there? And so it gets really complicated, but it's super fascinating all at the same time. Do you have any other hot takes around DePIN economics that we haven't actually talked about yet that you think is worth people considering or noodling over?
Yeah, I guess I think that I'm like, this is going to sound very off topic, but I'm like an evolutionary maximalist, right? So I like, nature to me is like the greatest wisdom. And like, when you look at, businesses have been around for hundreds of years, and businesses through the process of natural selection have come out to produce some really good models. And crypto allows us to improve those models, but we don't need to start from square zero. And sometimes I find like crypto founders, and myself included, there's this like desire to restart from scratch for certain things. And I'm just take buy and burn. Like, stock buybacks have been a thing for a very long time, right?
Yep.
When have you ever seen a public company commit to, we're going to take X percent of our revenue, potentially 100% of it, and no matter what the price of our stock is, go buy it back? It makes no sense to me.
Yeah.
Like, I would wait till we think the stock price is low, and then we'll go buy it back in bulk. We've been saving up money. Now we think we're going to be able to make this into something. We'll go and take a bunch of it off the market in one swoop through a board meeting and stuff like that. That to me is like a better mechanism for buy and burn. Don't buy your own tokens back in a bull market. That doesn't make any sense. Like, that is the lowest ROI thing for us to do with revenue, in my opinion. So for what reason would you do that? Your token price is high. So you're good. Now, like, to support that, go take the money that you got from revenue and go funnel that into building better products, make a better burrito, introduce Al Pastor.
Yeah, I love it.
Anything. Yeah. So I think we're in this crazy cycle, which we have been in for so long, about the fundraising, and the way that capital moves around this industry makes it such that the incentives are very perverse to finding real truths and like building sustainable companies, because it takes a long time, where going and issuing a token and bootstrapping a bunch of supply side, it becomes attractive because it might get you rich really quickly. But ultimately, anyone who wants to see this industry move far forward would be studying things that are outside of crypto, because we have plenty of distributed hardware networks in the world that are run by centralized companies, but we know a lot about this, right? I think hot take is, everyone should be doing more homework and not trying to invent from scratch, and not blindly following what other crypto projects are doing, because the incentives are sometimes wrong. So yeah, I think if you want to be here for a long time, when something smells funny, it probably is funny. We should all be questioning these things, but at the same time, not casting malicious intent on anyone, because I think we're all out here trying to survive and build interesting things. And so it takes a lot of experimentation and a lot of mistakes, and to get things wrong. That's just the name of the game.
Yeah, no, I so appreciate what you said about the perverse incentives, or just looking at things in a historical context and try to apply them here without needing to reinvent the wheel. And frankly, one of the biggest issues I've had with this buy burn model is that if you look at value accrual is maybe like a leading indicator for increased revenue or whatever, if we just make that assumption and we save it, there is a inverse correlation between price appreciation and the ability to burn more tokens. So you create this sort of perpetual holding pattern where we have value going up, but our ability to reduce the supply is going down at a correlated rate. And so now you've just created this kind of perpetual holding pattern where as emissions continue to happen, no one actually ever gets, the network actually doesn't benefit because it's doing things at the wrong time. And that's been an issue. And so I think it does really beg the question, what do we do instead? Because I think we understand that to some degree, we have to be able to reduce supply so that we don't have so that we have a deflationary metric in the network, but at the same time, it's got to be done at the right time. So I really appreciate that you're thinking through these things. What else are you researching or writing about that is coming down the pike that you want to plant some seeds for listeners?
Yeah, we're running a bunch of interesting pilots in the DeFi for DePIN arena, I would say. And that's just like how we operate too. We'll run really small experiments with different types of hardware providers and liquidity providers and see can this scale, or is this going to work on chain? Or we're going to publish those hopefully pretty soon with some learnings, and generally experimenting with collateralizing different things. To me, it's an interesting, like, even I'm looking in my closet right now, like I bought this like carpet cleaner for some reason, and it's really good when you need it, but it was like expensive. I should really be able to rent that out to like someone next door. Whether this is actually going to happen or it's a pipe dream is TBD, but just feel like if you have anything that you can earn off of that's in your home, you should be able to take a loan off of it. And that's where we're experimenting. And for your listeners, if you want to follow us and all of our experiments, follow at GLIF.io or at J_Schwartz, and we'll be publishing a lot of stuff and more concrete plans as well.
I love it. Yeah, Jonathan, this has been so fun being able to nerd out on a lot of these esoteric concepts in a lot of respects, but they're really important to try to move the space forward. And it's great that there's people out there like yourself, like Sal, who's writing these different articles. I put myself in this category to some degree of trying to say, hey,
absolutely,
we need to reconsider how we're evaluating these different networks and the model that we're using going forward. And like there's projects like Tashi, who I think are thinking through the applicability of it. The last question before we wrap, I was going to say, are there any projects that you're looking at that you think's doing outside of GLIF, obviously, who are looking at these kind of models and trying to innovate that are maybe interesting proof points for folks to go out and look at all?
That's a great question. I'll need to write more about that. I haven't done enough like individual research on individual projects in a long time. So I don't want to misspeak yet, but I will shine light on projects that I think are doing really interesting and honestly interesting stuff. Yeah, and like you said, and first of all, you absolutely are in that category. If anyone listening to this has not read your piece on DePIN discount valuations, you absolutely should. It's very interesting and really well thought through. So yeah, amazing. We should do another one of these when you have part 2. We can really get into the weeds. And maybe I just haven't seen much of it, but like these types of conversations are really promising for the industry to be like, hey, we actually do have a chance of making it within this sector, right? Because it's simple, like in a lot of ways. There's a lot of leftover hardware and we can put it to use and get a lot of really good data services out of it. That just makes sense. So, and crypto is the perfect ledger for that.
Yes.
To disintermediate the whole thing. So directionally, it's very obviously like a DeFi size category for crypto in my mind. Yeah. It's just, how do you spin it?
Yes.
And yeah, I think we'll need some more time.
That's the hard part, right? That's what we all need to figure out. I appreciate the feedback and being put in that category. And I fully agree with you. Like the DePIN model and just the industry has such a opportunity to really change the status quo. I think there's just a couple of those pieces that we're still working out that need people at least asking questions like, hey, is this the right approach? Are we thinking through this in a pragmatic sense? And where the model is going to lend itself to lots of continued future success, not just a short-term token appreciation play, but something that's in the long term going to disintermediate stuff like AWS, right? That's hard to do because they're conflicting value streams in a lot of respect.
Yeah, no, 100%. We also just need to survive. 0 to 1 paradigms take a while to get to that product market fit. Like I think Coinbase and Figma, these were like 7 or 8 years before they start to get that critical mass.
Yes.
So yeah, it's like being patient and tolerant for mistakes, but being aggressive and course correcting, I think is really important. Yeah, man. I
couldn't agree more. I couldn't agree more.
Well, very Jonathan, good job, man.
Yeah, we're definitely gonna have to have a second conversation on this, especially as you're putting out research, as I'm putting out things. We'll do we'll compare notes and say, oh, this is interesting. Hadn't thought about this. We'll have to do more of these. But I wanted to say thank you so much for coming on to take all the time to chat about this. Again, it's a part of the space that really needs more light on it. And so I appreciate that you're out there doing the thought leadership thing, putting yourself out there saying, hey, how are we thinking about this? Or hey, here's another idea. And you are certainly someone that's worth following. So we'll have all that link below to go follow GLIF, go follow Jonathan on X so that you can stay up to date with his research and writings. But I think we'll wrap it up here. Jonathan, I want to thank you again for coming on, and we'll see everyone on the next one. Take care.
Thank you. And thanks for your time.
Absolutely, man. Cheers.